At some point, you stop worrying about whether your card will decline, and you start worrying about something weirder, whether you're accidentally building a life that will keep you broke even as your net worth rises. Because that's the part nobody warns you about. The traps don't disappear when you have more money. They level up with you. When your net worth is near zero, the trap is obvious. You spend more than you earn. But when your net worth is $10,000, the trap looks like I deserve a little upgrade. At $50,000, it looks like I should probably buy a nicer car for safety. At $200,000, it looks like we can stretch for the house. Everyone does. And by the time you're doing well on paper, the trap is often invisible. It's fees, taxes, lifestyle expectations, and decisions that quietly drain your future. In this video, I'm going to walk through the most common financial traps you'll face as your net worth grows, in the order you tend to encounter them. Not to scare you, but to give you a map. Because the goal isn't just to hit a number. The goal is to keep the number, protect it, and make it grow without turning your life into a stress machine. Trap number 1 is the progress penalty. The moment you make progress, your life tries to charge you for it. You get a raise, and suddenly your friends want to celebrate with more expensive dinners. You pay off a credit card, and your brain immediately starts shopping with that freed-up payment. You cross your first $5,000 or $10,000 in savings, and a voice shows up saying, "You've been so good. You can afford this now." That voice is not your friend. It's your old habits wearing a new outfit. The antidote is painfully simple. When your income goes up, your automatic savings rate has to go up first. Not someday. First. In the US, that might mean increasing your 401k contribution or setting an automatic transfer to a brokerage or high-yield savings. In the UK, it might mean raising your workplace pension percentage, funding an ISA by direct debit, or building a cash buffer that stops you from using overdrafts and credit. The mechanism is the same. Your lifestyle can expand later, but your future has to get paid before your present gets upgraded. Trap number 2 is confusing cash with net worth. Early on, seeing a 5-figure bank balance feels like winning. It's not. It's a tool. And if that entire balance is sitting in a current account earning basically nothing while prices rise, you're losing quietly. The point of cash is liquidity and stability, not growth. So you need 2 buckets: an emergency fund that covers your essentials for a few months and a separate plan for long-term investing. If you treat your emergency fund like an investing account, you'll take risks you can't afford. If you treat investing like an emergency fund, you'll stay safe and broke at the same time. Now, before someone jumps in and says, "But investing is scary," good. A little fear is healthy. The trap is not fear. The trap is waiting for certainty. People postpone investing because they want a perfect moment, a perfect strategy, a perfect amount of money. Meanwhile, time is compounding against them. The easiest way to escape this trap is boring. Automate a small amount into a diversified fund you understand. Keep the fees low and keep showing up. You don't need a secret. You need a system. Trap number 3 is the car trap, and it evolves as you grow. When you're broke, the car trap is a payment that eats your entire margin. When you're doing okay, the car trap becomes status. You upgrade because you can, but you don't ask what you're trading. Every extra 200 pounds or $200 per month is not just a payment. It's the investment you didn't make, the flexibility you didn't buy, the stress you didn't remove. A car is transportation. The moment it becomes an identity statement, it starts charging rent in your budget. Here's a simple rule that scales with net worth. If the only way you can afford something is financing it, you can't afford it yet. That doesn't mean all debt is evil. It means debt is a tool, and most people use it as a personality. If you're building net worth, you want your monthly commitments to be low enough that you can survive surprises and still invest. A life built on fixed payments is a life that feels rich right up until it collapses. And this leads to the biggest early-stage trap that sets up everything else: building your life around the maximum you can get approved for. Banks, lenders, and finance companies are not your financial coach. They're a business model. They will happily approve you for a normal payment that quietly destroys your ability to build wealth. If your plan requires everything going right, it's not a plan. It's a gamble. In a second, We'll talk about the traps that show up when you're past the basics. The house upgrade trap, the two incomes trap, the invisible fee trap, and the social trap that hits when people start noticing you're doing better. But first, I want you to take a quick inventory. What net worth level are you at right now? And which trap feels the most tempting? Be honest. Awareness is how you stop stepping into the same hole with nicer shoes. One more thing. As your net worth climbs, the temptation shifts from obvious purchases to quiet commitments. It's the gym you never use, the just-in-case subscriptions, the bigger flat because you work from home now, the newer phone on a contract, the holidays put on a card because memories matter. None of these decisions feel like a crisis. That's why they're dangerous. They leak. And the leak worsens as you earn. Trap number 4 is the house upgrade trap. At a certain net worth, renting starts to feel like throwing money away, and buying starts to feel like maturity. The trap isn't homeownership itself. The trap is buying the maximum lifestyle you can justify because it looks like an investment. A primary home can build equity, but it also comes with a long list of costs that don't show up in the listing price. Repairs, furnishing, higher utilities, taxes, insurance, and the emotional pressure to keep upgrading. In the US, it's property tax, HOA fees, and maintenance that hits people. In the UK, it's council tax bans, service charges, leasehold surprises, and a constant drip of repairs on older homes. Either way, the pattern is identical. You take a stable monthly payment, and then you stack unpredictable costs on top of it until your cash flow becomes fragile. Net worth grows on paper, but your life feels tighter. And the most dangerous part is how reasonable it sounds in the moment. It's only a bit more per month. Rates will go down later. We'll refinance. We can always earn more. Those are not plans. Those are hopes wearing spreadsheets. The house trap usually doesn't blow you up instantly. It just slows you down for a decade. Trap number 5 is the two-income trap, and it's brutal because it feels like security. When two people earn, the lifestyle quickly expands to match the combined income. Nicer area, newer cars, private childcare, bigger holidays. The problem is that two incomes often create one fragile system. If either income drops, the commitments stay. And if you're single, this trap still exists. You build your life as if your current income is guaranteed forever. The escape is to build your baseline life on one income, or at least on a conservative version of your income, even if you have more. Let the second income, bonus, overtime, or side hustle fund goals, debt payoff, investing, big future purchases. This creates what most people think they have but don't: resilience. Trap number 6 is the lifestyle subscription trap. Not just streaming. Everything becomes a subscription when you're doing better. The nicer gym, the upgraded phone plan, the meal kits, the monthly skincare box, the premium banking. It's only software. Each one is small enough to ignore, but together they build a fixed cost cage. When your expenses are mostly fixed, every surprise becomes a crisis again, even with a higher net worth. Here's the rule. As net worth rises, your life should become more flexible, not more committed. If your monthly obligations are rising faster than your investments, you're building a beautiful treadmill. Trap number 7 is the invisible fee trap, the one that steals from people who are already disciplined. You start investing, which is great, but you ignore what you're paying to do it. A 1% advisory fee, a high fund expense ratio, trading fees, platform fees, management charges, currency conversion, spread costs. None of these feel painful because they aren't a single big bill. They're a slow bleed. Over 20 or 30 years, that bleed can cost you hundreds of thousands. You don't need to become a finance nerd. You just need to respect math. Fees compound in the wrong direction. A tiny drag every year is a huge drag over time. The wealthier you get, the more you must protect your compounding from parasites, even respectable-looking ones. Trap number 8 is the complexity trap. Once you've done the basics, boring starts to feel insulting. You're making progress with automatic investing, and then you see someone online flipping options, trading crypto, or buying exclusive deals, and you feel behind again. Complexity looks like intelligence, so people chase it for status. But most wealth is built by repeating simple behavior for an unreasonable amount of time. The question to ask at every new net worth level is this: is this decision increasing my long-term freedom, or is it increasing my short-term ego? Because ego is expensive. Ego buys the house that's too big, the car that's too new, the investments you don't understand, and the friends you can't afford to keep up with. Now let's talk about the trap that shows up when people can finally help. As soon as your life stabilizes, your social world changes. Family members ask for loans. Friends assume you're fine, picking up the tab. People subtly pressure you to prove you're still generous and still normal. This is the social guilt trap, and it can destroy both money and relationships if you don't set rules. You don't need to become cold. You need boundaries. Decide in advance what you can give, what you can lend, and what you simply don't do. A simple line like, "I don't lend money, but I can help you find resources," will save you years of drama. The higher your net worth goes, the more your peace is worth protecting. Another trap that appears around the mid-six figures is the tax drift. More income and more investing can create surprise bills if you don't plan. In the US, that might be capital gains, self-employment tax, or losing credits. In the UK, it could be higher rate bands, student loan repayments, or benefit cliffs. Net worth rises, cash flow suddenly doesn't, and you feel blindsided twice. The last trap in this section is the paper wealth illusion. A rising net worth can make you feel safe while your liquid cash is thin and your investments are concentrated. Home equity can't pay a bill next week. A pension, 401k, or ISA can be real wealth, but it's locked for later. And company stock or a single property might make your net worth look impressive while exposing you to one big risk. Real wealth isn't just a number. It's the quality of the number, diversified, liquid enough, and built on a life you can actually sustain. Trap number 9 is the concentration trap. When you first start building wealth, simplicity is good. One job, one savings account, one index fund. But as your net worth rises, it's easy to end up with a single point of failure without noticing. A big chunk in your employer's stock. One rental property in one neighborhood. One business client that pays most of your income. On paper, you look diversified because you have assets, but in reality, one event can cut your net worth in half. This trap is sneaky because concentration often comes from success. Your company stock goes up, so it becomes 40% of your portfolio. Your property doubles, so it becomes the majority of your net worth. Your side business takes off, so you stop nurturing other skills. The fix is not panic selling. The fix is setting a cap. Decide the maximum percentage you'll allow in any one stock, any one property, or any one income source, and rebalance slowly on purpose. Trap number 10 is the protection gap. Early on, you're focused on growth. Later on, the biggest threat is not a bad month. It's a rare event with a huge price tag, a health issue that stops you working, a lawsuit after a car accident, a pipe burst that destroys your home, a family emergency that forces you to travel, take unpaid time off, and pay out of pocket. When you have no savings, these events hurt. When you have savings but no protection, they can erase years of progress. This is where boring adult stuff becomes wealth strategy, appropriate insurance, keeping your emergency fund real, and not letting your deductibles and excesses be fantasy numbers you can't actually cover. The goal isn't to insure everything. The goal is to remove the handful of risks that can permanently knock you off the path. Trap number 11 is what I call the high-income normal trap. This one hits when you start earning enough that your problems look different from your friends. You're not choosing between food and fuel anymore. You're choosing between a 1,800-pound flat and a 2,400-pound flat, between a modest car and a luxury lease, between a simple holiday and the one that looks impressive. None of these choices feels reckless, and that's the danger. You can look responsible, earn more every year, and still never feel ahead because your definition of normal keeps inflating. A growing net worth should buy you calm. If it's buying you a more expensive version of the same stress, something is off. One of the strongest signals that you're trapped is when your pay rises but your savings rate doesn't. Another is when you avoid checking numbers because you're afraid of what you'll see. Wealth isn't the ability to spend. It's the ability to not be forced. Trap number 12 is the finish line illusion. People hit a certain net worth and assume the hard part is over. Then they relax, get sloppy, and let drift do the damage. The reality is that wealth is built in two phases: accumulation and maintenance. Accumulation is exciting. Maintenance is repetitive. But maintenance is where most people lose. Trap number 13 is the leverage temptation. Once your net worth looks healthy, lenders start calling you low risk and offering bigger limits. Home equity borrowing, balance transfers, even margin against investments. It feels like you've unlocked a new level, but leverage doesn't care how smart you are. It only cares about timing. If the market drops, your income dips, and a lender wants payments anyway, you could be forced to sell at the worst moment. Trap number 14 is the exit plan trap. A bigger net worth doesn't automatically tell you what you can safely spend. Taxes, inflation, and timing matter. If you treat your portfolio like a salary before it's ready, you create permanent pressure to earn again. Wealth isn't reaching a number. It's reaching a number that can survive you alone. So here's a simple framework to carry you through every level. First, protect your margin. Keep your fixed monthly costs lower than your ego wants them to be. Second, automate the boring wins. Pension for 401k, I say index funds, whatever fits your country. Third, cap your risks. No single stock, property, or job should be able to destroy you. Fourth, keep liquidity real. An emergency fund is not invested cash. It's permission to breathe. And fifth, upgrade slowly. If you want the nicer car, the bigger home, the better lifestyle, earn it twice. Once in income and once in the ability to keep investing anyway. If you want to make this practical, pick the net worth range you're in right now and call out the trap you're most likely to fall for. Under 10K, 10 to 50K, 50 to 200K, or 200K plus. Write it down, because naming the trap is how you stop it from silently owning you.